All right, let's talk about one of the most famous and maybe one of the most misunderstood tools in all of trading, the MACD indicator. You see it on pretty much every chart out there, but here's the big question. Does it really work the way so many people claim it does?
You've seen this, right? Videos and posts all over the internet making these huge promises. A super simple strategy, high win rate, works everywhere, and best of all, it just makes money. It sounds almost too good to be true. And that right there is the myth of the MACD we're going to dig into.
Okay, so before we go any further, what is it officially? Well, at its heart, the MACD isn't some magic black box, it's a pretty straightforward tool. It just follows trends and measures momentum by looking at how two different moving averages of a price are behaving in relation to each other. That's it.
But to really get why it works, and more importantly, why it sometimes doesn't, we've got to pop the hood and see what's actually going on inside.
So when you look at the MACD on a chart, you're actually seeing four different parts working together. You've got the MACD line itself, the signal line, the histogram, and that line right down the middle, the zero line. Each one tells you a little something different.
First up is the MACD line. This is really the engine of the whole thing. A good way to think of it is as the sprinter. It's calculated by subtracting a longer-term moving average from a shorter-term one. And because it's weighted toward that shorter-term data, it moves fast and reacts really quickly to what the price is doing right now. Okay, so if the MACD line is our sprinter, then the signal line, well, that's our marathon runner. It's actually a moving average of the MACD line, which means it's way slower and smoother. Its whole job is to kind of smooth out the noise from the faster line and give us a baseline to watch for trading signals.
And then you've got those bars, the histogram. This is maybe the easiest bar to understand visually. It just shows you the distance between the sprinter and the marathon runner. When those bars get big, it means they're far apart and momentum is really strong. When the bars get tiny, it means the lines are getting close and momentum is drying up.
So now that we know the parts, how do people actually use this thing to trade? Let's look at the first strategy pretty much everyone learns. It's visual, it looks easy, and it seems like a no-brainer.
This is the classic Trading 101 strategy. The rule is dead simple. When the fast blue line crosses above the slow orange line, that's your signal to buy. And when it crosses back below, that's your signal to sell. See? Looks pretty straightforward on a chart. But this is where we hit the big problem, the reality check. If it's really as simple as buying and selling when two lines cross, then you got to ask yourself a pretty obvious question. Yeah, exactly. If this one little trick was all it took, the markets would be a very, very different place. The hard truth is that this simple strategy has a massive flaw, and it can get you into a lot of trouble. And here's the weakness. The MACD is a trend-following indicator. That means it's fantastic when the market is moving in one clear direction, either up or down. But what happens when the market gets choppy and just starts bouncing around sideways? Well, those lines start crossing back and forth over and over, firing off tons of fake buy and sell signals that just chop up your account. And hey, don't just take my word for it. This is a really well-known issue. Even Investopedia points out that these false positives happen all the time, especially when a stock or an asset is just moving sideways without any real direction.
So if using the MACD all by itself is a recipe for disaster in submarkets, what's the fix? Well, you get smarter. You start building a strategy that uses other tools as filters to screen out all that noise.
A much better approach is to use a checklist. Something like this. Step 1, what's the bigger trend? Is the price even moving in the direction you want to trade? A long-term moving average like the 200-day can help with that. Step 2, is the price at a key level? You know, a clear area of support or resistance? And then, and only then, as step 3, do you look down at your MACD to see if you get a crossover to confirm your idea. This way, you're not just taking signals randomly.
Okay, so that's a much smarter way to use it. But let's zoom out even further and get a reality check. What are the big players, the pros, actually looking at? Are they just using a fancier version of this?
Well, this is super interesting. When you look at what a lot of retail traders are focused on, it's often finding that perfect setting for an indicator like MACD or RSI, looking for that magic signal. But when you look at what institutional traders are reportedly focused on, it's a completely different game. They're looking at things like volume profile, VWAP, and order flow, tools that show them where the actual money is moving and where big orders are sitting. And this idea that there's no one-size-fits-all setting is backed up by actual academic research. A study in one journal found that those standard MACD settings, the 12, 26, and 9 you see everywhere, aren't necessarily the best. To get the most out of it, you actually have to tweak the values for different markets and even for different companies.
So I think that brings us to the real takeaway here. What is an indicator like the MACD really? Is it a crystal ball that's supposed to predict the future? Or is it more like a better flashlight? All the evidence points to it being a flashlight. It can't tell you what's going to happen, but it can do a really good job of helping you see what's happening right now with momentum, especially when you use it as just one tool in a bigger toolbox instead of a magic button.